Sure.
Thank you, everyone, really, for joining us today. This topic, as if you've been online, you've heard me gasbagging a little bit already. This topic is a highly, highly relevant topic that really has sort of captured a lot of attention over the past, what is it now, 4 months since the UK budget, and frankly, rightly so. Inheritance tax is often quoted as the most hated tax in the UK. General perception is, well, I've been taxed all my life, and now I'm going to be taxed to my death as well. But it does raise a lot of angst and questions, and the complexities around inheritance tax. Well, put it this way, they were already complex, and now it's been made more complex, which is really not overly helpful, but it is what we have. So today's exercise really is for us to go through. The first thing we're going to do is recap the facts because that's important. There's lots of people being interviewed and articles being written, and but the most important basics are going back to the facts of what's actually changing, and actually, very importantly, the dates that these things are changing. For example, pensions in inheritance tax, we all know that's the headline, but it hasn't happened yet. And it will happen, or it's being legislated to happen, but it hasn't happened yet. So we'll go through that. I think the first thing we're going to go through is the facts, what's changed, the dates these are going to change, and then from there, once we've established that, we will go through our thoughts and also the some very common strategies that potentially could be useful for you. And so at the outset, clearly, full disclaimer as per normal, this is not financial advice. Any financial advice has to be done on an individual basis, and most importantly, with this particular topic as well, it's very much on an individual basis. So please bear that in mind. So Adrian, do you want to kick off and go through some of the facts and the dates that we know that have been the major changes?
Sure. Thanks, Adam. Hello, everyone. Thanks for joining us today. Um, yes, I think the first thing I want to do is just set the scene. So we're talking about inheritance tax, and the first thing is what is um, within the bounds of inheritance tax. So it's the concept of your or one's estate is what the government levies a tax on. Um, so obviously someone passes away and it's their estate that is taxed. So as an individual, you don't pay inheritance tax. You it's a gift that you give your beneficiaries. They get the tax bill effectively. So the first thing is it's your estate. The second thing I just think contextually as well is there's some allowances that you receive. So there's a nil rate band and there's a residence nil rate band. And so I just want to mention those because they're going to come up in a bit more detail in a moment. But each individual is entitled to a nil rate band of £325,000. So what that means is if you were to pass away and your estate was £325,000, there would be an estate of £325,000 less than your rate band, nothing left to pay any inheritance tax on. So the government has set those rates, and importantly, the first thing is what's not changing, the bands aren't changing. And as we know, inflation has been very present in our minds for the last 2 years, but it has existed and always been there. So these bands being frozen uh, means that, and the current freeze has been extended from 2028 out to 2030. So, that's 5 years. Even if inflation's compounding at a a low rate, um, estates will be growing just by virtue of inflation, and therefore the amount of relief is disappearing over time. So that's the first thing to bear in mind. Second thing to bear in mind is um, because we can't do anything in a straightforward way, there's a second band called a residence nil rate band, £175,000. This applies in certain circumstances. Most people who are passing on real estate to their direct beneficiaries will also benefit from this additional 175,000. So collectively, fantastic. You've got 500,000 that is deducted from your estate before any inheritance tax is paid.
Can I?
There,
Sorry, I'm just going to
yep,
add to that as well. So this also applies not just if you're passing down solely property, but for example, if let's say, let's use an example of someone's elderly parents, elderly mother, elderly father, if they're the sole surviving parent and they sell the house and then move into a home, it's still they will still get the residence nil rate band, even if they don't actually own the property on their date of their death. So that's important to know. So just because you sell the home, it doesn't mean you lose this allowance as well.
um, yes, indeed. There's a number of complexities around the residence nil rate ban, not least of which the next point I was going to mention, which is um, this additional relief tapers away once estates reach £2 million. So again, that limit has been frozen. We're going to come back to that because this is all part of this web that's been woven around the changes. But broadly speaking, 500,000 for most people is the amount of relief you have. There's also between married couples, if you pass, if you're passing away and your will leaves your estate entirely to your spouse, there is no inheritance tax payable on that transfer, and these reliefs can be passed over as well. So prima facie, a family may have a total of £1 million total relief from inheritance tax. Now, again, that's all been frozen out for another 5 years, so sounds a big number. Where this has become increasingly problematic for a number of our clients is, of course, most of our clients are in sort of London area where we operate from, and therefore, if you own a house in London, you're almost certainly going to be above that £1 million or certainly nudging up against it. So what wasn't such a big problem for some people is now becoming increasingly a problem for just people who own a half decent family home in London. You're now talking about paying inheritance tax. So that was the first thing I wanted to lay out just in terms of the landscape. The residence nil rate band has some complexity around it, but broadly speaking, the 325 applies to everyone. And so most families, their starting point is they have £1 million of relief. There were and still are things that are excluded from your estate, which means that when you pass away, there's certain assets that are not included. And as of today, most pensions are excluded from your estate. However, the Chancellor has decided that from April 2027, so not this April, next April, that pensions will be included in your estate for inheritance tax purposes. Now, that obviously, again, if you're one of our clients, you live in London, you've sort of, let's just call it, got a property around £1 million or more, all of a sudden your second biggest asset, your pension, particularly if there's two of you who've worked for most of your careers, two big pensions wheeled into your estate, and you're certainly looking at paying a significant inheritance tax bill, whereas perhaps previously you were looking at a much more manageable amount. Um, we're going to go into that in a bit more detail in a moment, but the biggest problem I see is, and the bit that hasn't been talked about a lot, is with two pensions coming in, with a property coming in, with some other assets coming in, people are going to start losing the residence nil rate band because estates are going to be bigger than this £2 million threshold where the residence nil rate band starts um, being tapered away. It's one of these tapers, £2, £1 for every £2, and so at 2 million and 2,350,000, you've lost that £175,000 residence nil rate band. Sorry, that's getting a bit complex and messy, but that's kind of why we're having the conversation today. So, um, and that's just sort of setting the scene right now. There are some other things that are outside estates, but controversially have been brought up as well. Do you want to talk briefly about agricultural relief and business property relief?
Sure, happy to. So, historically, both agricultural land, and unlisted businesses of which you have owned for 2 years or more, and then more recently, AIM listed businesses, which is companies that are listed on the AIM stock exchange. Again, if you've owned that for 2 years or more, all of those um, those assets, as long as you've owned them on your death for 2 years or more, were exempt from inheritance tax, which was fine. And so, therefore, because of those call it quirks within the inheritance tax legislation, they're created a number of different and totally legal and justified inheritance tax investment products. And so there was land you could buy, agricultural land as an investment product. You could buy AIM listed shares as an investment product. You could buy stakes in private businesses which did things like asset-backed loans. So these products still exist. What has happened though is instead of the relief being unlimited, the relief has been capped on both of these, and both the private businesses and the agricultural land, the relief is capped at £1 million for the total assets, and then anything above 1 million, you get effectively, instead of paying, you still get some relief, but instead of paying the 40% inheritance tax, you pay half of it. So 20% inheritance tax on anything above the value of 1 million. So this is really what has, excuse me, this is what has brought the farmers onto the streets of Westminster. And I can understand this because, frankly, farming is hard enough, let alone the risk of that being passed, effectively having a relatively, a valuable farm being passed down the generation and then having to pay tax on it at the same time. I can kind of understand their frustration. There's a lot of other articles going on around saying about how it's only going to impact a certain number of farmers, and we're not going to get into the detail of that because it gets too political. But principally, again, what was a relief has now been capped and changed. So that's the major change. The thing with this is the fact that this change comes into effect on the 6th of April 2026. So coming out April 2025 this year. This will be a 1 year's time, 2026. The pension change comes in the following year, April 2027. So this is where the dates kind of become important in terms of it's not everything changing at once. So that's the major change around the inheritance tax on business property and agricultural land. So the products, there are some people, and we use these inheritance tax products on private businesses. They're still around. They still exist, and frankly, they actually still make sense. Principally, with a limit of £1 million into these particular assets, that's a lot of money going into this particular type of asset as well. So the limits aren't going to impact, as far as our client base, are not going to impact, I think, frankly, anyone that we have who has more than £1 million into these particular products. Who this does impact is, clearly farmers, but then it also impacts other small business owners who own large stakes of private businesses. And that's just something to consider as well. So this again, it's something. They've made the change in the system. We don't think it's going to impact any of our clients going forwards, but it may in the future, and it's something to be aware. Adrian, do you want to go back through the? So we've talked. Do you want to talk more about pensions around, or you've talked?
Yeah, well, I think what this budget has done, and there was some talk that the previous government was going to abolish inheritance tax, and they never did. Perhaps a missed opportunity there. But anyway, the changes have brought inheritance tax and the potential liability. There's a little bit of mechanics here that make this a little bit uncomfortable for some people, largely because if your assets are effectively your pension and your property, and you pass away and you've got, say, children who are not yet adults, uh, and probate currently is taking somewhere between 12 and 24 months to get processed, uh, and it can't be processed unless the trustees have met the inheritance tax liability. What happens to your children in the meantime? What happen? So that frankly existed already. That risk. It's just that all of a sudden now, because people have started focusing on inheritance tax, and part of the reason we're having this webinar is to just sort of think through what are the real challenges as of today and the risks as of today with inheritance tax, and then what are the things we might want to consider tactically around that today, and then what are the challenges going to be, as you say, over the next 12, 18, 24 months, assuming that the current plans are the only plans that are legislated and get put through as they stand. So April 27 is a long way off in politics, so who knows what they'll have come up with by then. So there is a bit of, you can only really plan for the landscape as it is. We can be mindful of the changes that are earmarked to come forward, but I think what we're really talking about here is what risks are you facing now? What things do you need to think about now, or could you be thinking about? And then this conversation is going to evolve over time, and it's going to be, it's going to be years that it unravels over rather than days and minutes, isn't it?
Yeah. No, I think, and you raise a really good point because a very valid um, point has been raised about pensions and about beneficiary pensions being brought into inheritance tax. So beneficiary pensions currently at today, so which is as the rules as they are today. So we're not at April 27 yet. So if you die at 75 or over, your pension is passed to your nominated beneficiaries outside of inheritance tax, but your nominated beneficiaries, because you died when you were over 75, when they draw the funds, it is taxable at their marginal rate of income tax. So that's as they exist today. The change in the proposed changes make no mention of that existing taxation. So the proposed changes, as they have been announced today, there is an inheritance tax on the pension, and then the pension is still subject to margin rate of income tax as it's being drawn. That, to me, sounds like an unintended consequence, and someone didn't quite connect the dots. Who would have thought? So this is not passed completely through all the legislation yet. So that is actually very important to mention. These are rules that they have been announced. They have not actually passed into formal legislation, and there has been a strong pushback and a strong view that this double taxation of pensions won't actually come to fruition. There has been mention of this going back to kind of the 55% tax level, which was when people used to be charged going over the lifetime allowance. When they pull money out, they'd be charged a 55% tax instead of this double tax. So again, this is a moving feast. This has not gone through formal legislation yet, so it's not absolutely decided. But so there will be some more changes that will come and be made. But my first thing I want to raise is actually when we look at these changes, who actually loses specifically? Who is impacted the most by these changes? So the first one is the farmers, clearly, and I'll leave those. The second is, and I've actually had conversations with clients about this, unmarried couples who have children. They are impacted here because typically on the death of a spouse, you need to be in you need to have a legal arrangement with your spouse to have your assets pass from one spouse to the other on your death with no inheritance tax. You need to be married or need to be in a civil partnership. If you are just cohabiting, even though you've been cohabiting for years and just never quite got around to getting married, there will be inheritance tax on your the first death, even if the assets all go to the surviving spouse. So that's really important. And I've had a couple of conversations with the idea of like, you might want to choose to get married because that's important. And that's actually because otherwise it's a risk. Another group of people who are at risk here are single parents. So single parents who have, say, teenage children or something like that. Because, and when I say single, this is either, whose spouses unfortunately have passed away or who have divorced. Because in both of those cases, if the parents, if their assets aren't, if they don't have a spouse or a legal spouse, either a civil partner, civil marriage, to pass the assets to, and the assets designed to be passed to the children, therefore that's also subject to inheritance tax. And for example, let's say you live in a decent sized family home in southwest London, there is inheritance. That home is included in the estate, and there potentially is inheritance tax on that home. So as Adrian said, as the probate goes through, the tax will need to be paid on the total value of those assets before that's released. So there needs to be other assets used for found somewhere to pay the inheritance tax on the home to enable the children to live in, to remain in the home. So some of those are unique situations and frankly quite potentially very painful. So those are the big kind of what we call, say, I would say, unfortunate, the people who have been hit the hardest from these change in legislation. The other one is also, like most changes in rules, it's unfortunate when people, we do retirement planning under a certain set of rules and then the rules change. And so then that retirement planning is changed. And I know, there are a couple of people I know on this call, people who previously have transferred out of, final salary pensions to create a big, a good sized sum that they could live off, that's invested and they could live off. Frankly, that strategy has worked very well so far. One of the benefits of those strategy, that strategy was the idea that you had a lump sum that could then be passed down to your beneficiaries, as opposed to in a final salary pension where it can't be. As a final salary pension, when you die, that pension basically stops, or potentially there's a spouse pension paid. So that is another group who have also been unfortunately disadvantaged by these changes. So now I guess it's time to think, okay, that's fine. We've explained the rules, we've explained who's been impacted, but now, so the question is, okay, what can we do about it? And so, Adrian, do you want to kick off with a
Sure.
couple of strategies that we've kind of thinking about and the sort of structure that we use to kind of think through this?
Yeah, sure. I mean, I think the first point is um, this is going to be very personalized because a lot of the mechanisms for mitigating inheritance tax involve things like I'll just throw out the headlines, but trusts, gifts, or investing in assets that qualify for business property relief, things like that. So these are not your everyday sort of events, and people have very different views on what age they want to pass money on to children and grandchildren, all that sort of stuff in the gifting space, or giving up control to move things into trusts, or so very personalized. But just broadly speaking, go back to my original point, inheritance tax is payable on your estate. So the first thing to say is, well, what is in and what is out of your estate? Let's put pensions to one side because they're currently out, but they're going to come back in a couple of years' time. So what else potentially could be outside your estate? So um, one of the places a lot of people start is gifting. Now, gifting, uh, as I've mentioned, different emotional responses across the board there. Everyone's got their own view on these things. Um, Gifting, there are certain, like everything, it's not straightforward. There are some rules around them. People will have heard of the 7-year rule, mainly because that's now in the press and possibly being reconsidered. So I'm not sure what they're reconsidering it, what they might replace it with, but that's pure speculation. But it has been raised in the press. Presently, there's a number of smaller opportunities to make gifts for small amounts, which um, tend not to move the needle too much in terms of inheritance tax when you look at them in isolation. However, you can annual allowances and small gift exemptions and things like that. They do add up over time, particularly if one's got, a portfolio of grandchildren or someone that they're making gifts to and things like that. The money certainly adds up over a few years. But um, wedding gifts is another one where you can make contributions of a few thousand here and there. There's two or three main areas of gifts where we talk about slightly bigger amounts of money. One opportunity is around gifts from regular gifts from surplus income. Now, what that means is you have to be able to demonstrate that you're, for instance, if you're retired and you've got your state pension and you've got a small DB pension and that's meeting all your living costs, and you've got some other money, you can another source of income called maybe property income or something, whereby you can demonstrate that that's surplus to requirements and therefore you're entitled to make gifts out of that surplus. That's an area that's uh, one where there are opportunities to perhaps look at pensions in the longer term and the like. Adam might go into that in a sec, but that's one area. The other one is making larger gifts. And this is where the 7-year rule becomes a factor. And we'll talk about what that means. Um, Obviously, the government, HMRC, don't want you to just give away all your assets and just remove them from your estate. So they've set limits around that. And one of those is that if you make a potentially exempt transfer, a gift to someone, then that's fine so long as you survive for 7 years. So what happens is that the potential in that potentially exempt transfer becomes an exempt transfer. In other words, it becomes a transfer out of your estate after that 7 years has expired. Um, what that means is that during that 7-year period, you start off, if you were to pass away, that remains in your estate, but after a few years, that the inheritance tax amount tapers down as well. So complexity on complexity there, but that can be a useful way of, if you want to help your children with a deposit on a house or something like that, those types of gifts can take assets outside your estate, subject to the 7-year rule. So gifting with there is a lot of complexity around that. The first and most important thing with gifting is record keeping, because the onus of proof will be on you or on your estate to prove that the gifts meet the criteria. So record keeping very important there.
Just on the gifting as
On
well, this
gifts,
is
Adam,
also where it's really important in a lot of ways, kind of what stage you are. So the gifting, the idea of, if you're 45 versus if you're 65 versus it, no, sorry, if you're 45 versus if you're 60 versus if you're 75, kind of you're in three very different places in terms of gifting and what that looks like and the priorities around that. And that's simply because ultimately, let's not beat around the bush. The best way to reduce your inheritance tax is spend the money. Go and enjoy it. Have fun. That's what it's there for. It's your money. Go and spend it. So fly up the front of the plane. Do that sort of stuff. That's the best way to do it. And I know there's one particular advisor who does retirement planning at another firm who has these 40% off stickers he gives out to his retiree clients to say anything you spend here, it's 40% off, because it's basically saving, you're spending it now and the tax man's not getting it. But the idea, so that's the context in terms of the best way to reduce it is to spend the money. The second best way to reduce it is to actually, all right, if you don't spend the money, yes, is to gift it away. But the problem with gifting it away is once you've gifted the money, it's very hard to get it back. And none of us know how much longer we're going to live for. And none of us know what's going to happen in the future, especially with the elephant in the room, which is care costs are bloody expensive, pardon my language. Many of you I know have experienced this, and they are just getting more and more and more expensive every year. It's basically like school fees. So we don't know individually, all of us, how much it's going to cost to keep us in care, and how much it's going to cost to keep a spouse in care. All of those things. So the idea of gifting away everything to reduce the tax burden to below £1 million sounds great, but actually you might need the money. So there is a buffer around that. The other aspect around this is, especially more for, let's say, the 60-year-old, and especially for the 45-year-old, these are the rules as they are today, and were they, subject to changes in the next couple of years. These rules will change again in the future at some point. We know that for sure because it's a popular tax. When I say popular, it's a very popular tax in terms of it's a very well discussed tax, and people have very strong views. So different parties coming in potentially have different ideas and different views on it. The idea of a fit and healthy 45-year-old, frankly, the chances of these particular rules impacting you very, very low, given a generic life expectancy of potentially another 40 years of there. So again, it's the context of it's worth understanding what the rules as they are today. It's worth thinking about it. But the idea of, for many of you and many people we talk to, actually the best strategy is to actually not do anything at this point, because it's just wait and see. If there is a diagnosis that comes in, if something happens, if life expectancy is shortened, then yes, there is actions that can be taken, absolutely. But in the context about planning, about all of those things, time does change, and rules do change, and governments certainly change. And so most likely, frankly, for most of you, whenever you die, these are not going to be the exact rules that effectively will impact your death. So that's just kind of, we're conscious of that as well. And this is the nature of actually one of the key things we always talk about. You've probably heard me bang on about it ad nauseum, which no one else seems to talk about, is the benefits of flexibility into any financial planning. And the flexibility has to be key, because frankly, your life changes, the rules change, governments change. Plans have to be flexible. And so, for example, buying an annuity because you want the income and you don't want to pay inheritance tax, that's fine as it is today, but if everything changes, you can't change the annuity. And so that might not end up being the best strategy. So that's just something to be, I just wanted to make that, conscious, to make that, or to publicize that and make people think about that yes, people do get worked up about this. And we've had a lot of people who are worried about it, but at the same time, again, this is just a context of, we don't know how much you're going to need for the rest of your life. We want to make sure that the most important thing is simply you do not run out of money. That's the most important thing. And so therefore, there is an element around there can be an element around gifting and planning, but that is really as someone approaches sort of, let's say, their 70s and onwards, I think, in terms of really that focus. If you've got a significant asset base that you can pretty much say, whatever happens, you're never going to run out of money, and you're younger than that, great. It's a great position to be in, then we can look at doing some things as well. But really kind of the idea of the older, one gets, then frankly, the more important making some choices around this is. And I think Adrian sort of mentioned the one, I really do want to highlight the one particular area that I think is valuable is this regular gifts from surplus income, because this is one that actually is really simple. It's just, as long as it's documented, we can easily prove it that it doesn't, that it is surplus, because that's ultimately what, if there is any HMRC investigation, they will want to prove that it is surplus. And so you can just show the records of expenses, and this is income, and do that. And it's straightforward, because it's just money handing over on a regular basis. So setting up a regular transfer going off to someone, or, for example, regular transfers into grandchildren's school fees, something like that, another idea. So that's one particular area around the gifting element that is that we see quite regularly. The other sort of two most common elements are houses for children, bank of mum and dad, which is, I think, something ridiculous like the first or second most popular way of sourcing income behind a mortgage, or sourcing an asset, sourcing money for a property behind a mortgage, and are not far behind a mortgage. So Bank of Mum and Dad is a very popular vehicle to use as a gift. If you own investment properties, the idea of effectively doing a transfer of ownership to children. Now, the key with that is that clearly, if you own an investment property, and then there's going to be some legal costs in terms of that, and we've got to, because there's a change of ownership, there might be capital gains tax due, so something to look out for. B,
Stamp
therefore,
duty.
any future rental income goes to the owner, so potentially goes to the children as well. So you can't keep the rental income from doing something like that. So that's another thing around, in terms of, instead of just gifting money or gifting cash, it's gifting an asset. So, and again, when you gift that asset, there potentially is a capital gains implication if you pass that asset down a generation. If you pass the asset to a spouse, no concerns with the capital gains. On both of those, yes, though, watch out for there are going to be costs involved in terms of the legal documents and things like that. So that's kind of the gifting element. And I think kind of segues nicely in terms of, Adrian, so we start talking about trusts. And because ultimately, how do you
Yeah,
fund the
sure.
trust? Normally, you gift into a trust. And this is where Adrian, you want to continue that?
Yeah, I mean, trust is something and I'm speaking to someone yesterday who, um, eh, trusts is something that are less well understood in the general populace. Um, and so some people are very wary of them because they're this mystical thing that they don't quite understand, which is, fair enough too. I had someone say to me yesterday that they'd been told they didn't have enough money to consider trusts, which, to be fair, I mean, is something to consider, because trusts come with costs like anything that you do. So you need to be mindful of, the value for money, if you like, of anything that you're looking to contemplate, and the risks involved and so forth. Trusts don't have to be this sort of dark arts. There are a number of um, ways of thinking about trusts from an inheritance tax point of view that are relatively straightforward, that don't involve you getting a whole team of lawyers to draft some great big document and having, trustees on the payroll and all this sort of stuff. Although you can end up going down that route if you're not careful. Um, Certainly, there's a number of different types of trusts. I don't think we should really go through and list them all, but I just wanted to say that one type in particular that the government and HMRC are not so keen on is discretionary trusts. That doesn't mean they don't have a place. A discretionary trust is where the trustee, the person or the persons or the corporate that's in charge of looking after the assets that have been settled on it, have discretion as to who benefits. And that makes authorities nervous. And so the taxation of those trusts is, uh, let's just say, complicated. They get taxed every 10 years. Often settlements on discretionary trusts are taxed at the outset. So to be used in very, very specific circumstances. But there are a couple of more straightforward trusts where some protection can be achieved. And I want to come back to this idea of some protection rather than this is the silver bullet, because there is no silver bullet. Everything has pros and cons, and that's kind of what you hopefully will take away from this. You need to sit down and think hard about what is really concerning you and your family and how you want to go about it and what the options are. But Adam, do you want to just talk about the couple of specific trusts that you've got in mind regarding inheritance tax that can be quite useful?
Sure. Yeah. So, I mean, a common trust that we do see, which is relatively straightforward, is something called a loan trust. So, a loan trust is kind of, as it says in the tin, it's effective. You take a lump of money, and instead of gifting it into a trust, you loan it into a trust. So, effectively, let's say, for argument's sake, let's say that the figure is £500,000, and you loan £500,000 into a trust. Now, this is not a gift, so therefore, it doesn't qualify as a exempt or as a chargeable lifetime transfer. Once that money is in the trust, that money retains yours. That money is technically still part of the estate, but because any growth in that money is outside of the estate. So it's quite useful. As every with each year, you can also, using the £3,000, for example, annual allowance, annual gifting allowance, you can effectively chip away. You can say each year I'm going to, effectively gift £3,000 of that away, so that can kind of drop, albeit it's going to take a long time. But something like that is relatively straightforward. It's also straightforward where if you ever need the money back, it's still your money. And so you can bring the original capital back. So the 500,000, let's say it's done well. You've had it in there for 10 years. It's grown at 7% a year. So it's doubled. So 500,000 has become a million. And let's say, actually, I'm now, unfortunately, now I need a lot more care. So I'm going to bring back the original 500,000 into my estate, and I'm going to go spend it because I need a lot more care. Great. Because that way, then the original 500,000 comes back, and the growth of the 500,000 that stays in the trust remains in that trust, and therefore is outside of the estate. So that's one that is relatively straightforward and is quite popular, that I've seen occasionally. The other one, which I see occasionally, which has become a little less popular recently, but it still works, is something called a discounted gift trust. So a discounted gift trust is where you gift money to trust. So again, this time you actually are gifting the money into the trust, but the trust has in it the rules where it must pay back to you a certain amount of income every month or every year. So you're basically gifting money over to the trust, and then the trust pays you back a certain amount of income. What this does is effectively, it's a bit more complex. It requires an actuarial calculation by an actuary who says, okay, so there's money going in, but then there's also money coming out. So there is a calculation done to say, okay, what is the gift value of that? So for example, again, if you send over and gift £500,000, but you're taking back in £1,000 a month, and you happen to be 55, the actuary will do that calculation to say, okay, so 500,000 goes in from a 55-year-old, but yet they're going to get £1,000 a month back, and their life expectancy is another 30 years. What does that look like from a gifting perspective? And so they will then say, okay, they'll effectively calculate a number to say that gift is representative of £150,000 as a gift today. So even though you've moved 500,000 out of the estate, it's technically seen as a gift of 150,000. And so the important level there is that the fact that you've gone, even though you put more than the 325,000, which in vanilla terms should be chargeable at a tax above that, but because you're taking the money back in, actually you don't get charged that amount. We do see that. I've seen those occasionally. I've used those occasionally. The problem with those is that once you have set these things up, it is very, very, very difficult to change. You can't increase, it's hard to increase the income payments, stop the income payments, get the money back, all of that stuff. Pretty much once that trust is set up, it's really, really difficult to change, and you've got to kind of collapse the whole thing, and it's a complete mess. So that's another one we see that works occasionally in the right situation, but sometimes I have seen in one situation where someone tried to change it or undo it, and it was just they ended up paying a lot of money in legal fees, and didn't really work so well. So they're trusts, but again, this is something where trusts have come back on the radar a little bit. I mean, historically, again, you hear the stories of trust fund children, all of that stuff, and trusts used to be very, very well used. And up until, I think it was the late 90s or early 2000s, where they brought in the gifting rules into trust and effectively capped that gift at the 325,000 level. That was available to you before having to pay tax. And that really decimated the trust industry. But given these changes now and the focus on inheritance tax planning, we have seen it kind of come back up a little bit. So it is worth considering as one of the options we could potentially use.
Yes, so there's a couple other things to discuss. I'm just sort of keeping one eye on the time because we've been talking for a while now, as we're both prone to do. Um, there is a reduction in the rate of inheritance tax available if you leave 10% of your estate to charity. So for people who have substantial estates and perhaps have well-established children, grandchildren, or no children, or um, where they have charities that particularly, invested in. It is something to just bear in mind and consider. So that reduces the inheritance tax rate from 40% to 36. So um, another string to your bow, if you like, to reduce that overall amount of tax payable. Um, the last thing, well, the last sort of tool, if you like, that I want to raise, and it is another one that very circumstance dependent, but broadly speaking, insurance policies. So we've talked about the issue with probate and timing, or there's a number of things where either you're making a gift that has 7 years before it's fully outside your estate, or um, it- there are circumstances where you look at the overall picture and you're not comfortable that the estate is going to go the way you want it to, and it's worth considering getting some insurance to meet part of the inheritance tax liability, or to cover the inheritance tax on, say, a gift for a period of time. There's a number of policies around. We have done less of this historically, and it has become something we've talked a lot more about with clients more recently, because the specific risks that they're looking at, where we can take a view and say, okay, you may not want to take a whole of life policy for the whole of the potential inheritance tax of 2 million or something you're looking at as of today, because that's going to cost you an absolute fortune. But there may be some tactical uses for protection. As I say, if you're going to, for example, give your children a deposit on a house. I mean, you might be feeling particularly generous and go with 200,000 or something like that. Great, they've got a deposit on the house. But if something happens to you, there's an inheritance tax bill on that for a period of time. So a policy designed specifically around that level of cover for 7 years with a reducing balance, i.e., as the inheritance tax liability comes down in the latter years, 5 and 6 of that 7 year term. Uh, for an insurance company wanting to write a policy on that, they've got a reducing balance, if you like, as the time goes on, reducing risk. Those sorts of premiums can be quite reasonable and mean that you have the peace of mind of knowing that you have actually given your child a start on the property ladder, rather than a start and then a kick in the teeth if something happens to you 2 years later and they've got to find 40% of that, which they never had in the first place. So specific example there. Um, but protection does have a role to play. The other thing, some people who've got children who are not yet adults, or are sort of teenagers, and looking at saying, well, I don't think I need whole of life cover, but if something happens in the next 5 years or the next 10 years, they may be just getting out of university, or do we have enough protection? Is there enough resources for them to get through university, or if that's what the ambition is for the children, whatever the circumstances are. So taking a view on a certain amount of money for a certain period of time, and often exploring what that sort of protection looks like, much more cost effective, much more driven by specific circumstances rather than sort of a big blanket cover, is something we're seeing a lot more of, talked about, and talking with clients with.
Yeah, and I
Um,
think that you raise a really good point there, because the protection element is really, it's solving. So insurance is also, the whole point of insurance is to solve for a particular risk, and to effectively, if something happens, what do I want a lump sum of money to help? And so I go back to my original example around the single parent living with teenage children in the 5 bedroom house in Richmond, for example. And so that is significant. That will have significant assets, sorry, significant inheritance tax due on that house alone. So the thinking was, okay, So the risk is, all right, not only do these teenage children lose their mother, but actually they may get kicked out of the home because there's not enough other estates to, not other assets, sorry, to pay the inheritance tax due on the property. So the potential insurance is, okay, if we look at insurance policy for 10 years to cover the potential inheritance tax due on that property, written in trust as well, which is really important when doing single life insurance, because when the single life insurance is paid out, unless it's written into trust, it goes into the estate, which is not actually that helpful at all. Joint life is different, just as a side note. Joint life insurance is fine because on joint life insurance, on the death of the first, it is paid to the survivor. So that's okay. On single life insurance, that's something to be very aware of. It's for 99 times out of 100, single life policies should be written in trust. And yes, so the idea was effectively said, okay, we want to solve for 10 years because in 10 years' time, A, the children are going to be in their late 20s, maybe early 30s, potentially more financially self-sufficient and potentially even moved out of home. And B, frankly, in 10 years' time, the rules have probably changed anyway, and the figure might be different. And so and because you're getting insurance just for the next 10 years, for argument's sake, that's from age 55 to 65, that's a hell of a lot cheaper than getting insurance that from 65 to 75 or 75 to 85 because of your life expectancy at that age group. So that's one particular example that I think is definitely worthwhile. The other one we do see, and it's really interesting that insurance companies are cottoning onto this now, because we see much more joint life second death policies available. So historically, joint life would be, spouses married. If one, they're both covered. If one was to die, then they would get the payout. In this particular new policy, so joint life second death, because remember, inheritance tax is only on the second death, both of the spouses will have to die before there's a payout. But actually, that's when both spouses die is when the inheritance tax is due. So in those policies, you think about from insurance companies as just nothing more than probability. The probability of both spouses dying within the certain time frame is lower than just one spouse dying. Therefore, the premiums are cheaper. And so that's another, and it's interesting. So those insurance companies, there are more insurance companies offering those sort of policies now, and they come at a cheaper premium than your bog standard insurance, which is interesting. Just a couple of other things, given we've got 5 minutes to go to wrap up. Other areas that potentially could be interesting for, again, very individual situations. If you've got a significant property asset and you don't want to sell the property, something like equity release. Again, we don't advise on equity release, but it is something that where effectively what equity release does, it takes an ownership of the property. It takes a chunk of equity of the property, brings it into a cash, and then effectively the value, you're moving equity out of the property into cash. You can then potentially do more things with that cash whilst you're still alive, either invest it or gift it or something like that. And then on your death, then that property has a debt and that debt will be paid back on the death. Again, very individual, not for everybody. The equity release industry has been cleaned up a lot in the last few years. It's not just full of charlatans and sharks anymore. The big insurance companies have arrived and have cleaned it up a lot. So it's not something actually we go out and do, but it's worthwhile mentioning. The other one I just wanted to mention that Adrian mentioned briefly is the idea of the charity aspect. And there is an aspect of that which is interesting, and again, it's relevant for maybe relevant for some people, is something called donor advised funds. So donor advised funds are becoming more popular. This is effectively where you gift into it's effectively, I guess it's a trust, but because the trust is a donor advised fund, and ultimately that is, you control how that's invested. So you have effectively, it's out of your estate. It sits in a fund, but the rules are that fund has to be invested, the beneficiaries of that fund have to be a charity and have to be a registered charity. But you can decide the charities today, or you can change the charities. You can not decide a charity today and decide a charity in the future. But ultimately, what you can put a block of money into that, and that money is not seen as that money is out of your estate on day one, and you can put an unlimited amount into that fund. So this is an interesting vehicle for people with philanthropic ideals, but don't want to think about it too much at this point and just want to know, you know what, I've got significant assets here. I want that money to go to charity. I don't know the charity anymore that I want to use, but I want to get this money out of my estate, but I don't want to pay tax on doing that. So a donor advised fund is something that I think certainly in the States is very popular and is becoming more popular here. So that was just another potential option for you. But just to kind of wrap up as well, and I think we've mentioned a
Yep.
number of different factors. And the key thing in all the discussions both Adrian and I have had with clients over the past 4 months or so, and we'll continue to have these same discussions, is there is not one silver bullet. To reiterate what Adrian said, there isn't one thing. And frankly, there will potentially be potential tax on your estate at some point. There's not a whole lot we can do about that because ultimately, as I said originally, the most important factor is to make sure you as an individual do not run out of money yourself in your lifetime. So that means leaving a bit on the table. Secondly, there effectively are a menu of items available. And the best combination would be based on your individual circumstances is actually a combination of these. You might get some insurance, you might do some trust planning, you might look at, doing some regular gifts of income. All of those things, there isn't one normally there isn't just one solution is the best one. Normally it's a multiple number of solutions will probably be the best. And finally, again, I'll just reiterate again, these rules will change in the future. And just because they're punitive today, and just because you might be in the bucket today that gets hit the most, it might change in the future. And in the few years' time, we might have a different government, and it might be totally different. And there's much ink will be spilled and keyboard strokes wasted on speculating what it's going to look like, and ultimately we just don't know. So thinking about it is good. You've taken the first steps by engaging with this today, so thank you, and I hope you've enjoyed it. But ultimately, it's a case of this is a conversation worth having. It's a conversation worth starting. But the key point is it's just a start. It's a conversation. It's working out the goals. It's working out the key risk areas. And then it's coming up with an individual-based plan for that. So thank you for joining. Adrian, don't know if you want to finish off.
Yep. No, thank everyone for attending, and looks like just about everyone stayed the whole webinar. So we've managed not to talk everyone off the line. So that's a bit of an achievement unto itself. So
And there will
thank you,
be
everyone. Look forward to speaking to you again soon.
we will be sending out this is being recorded. So if you want to watch this again, or you want to send this to family members, anyone, please feel free, and we'll send the link out to anyone who was watching today. And yes, thank you for your time.